I want to bring in Chad Beynon. He is at Macquarie, senior gaming, lodging, and theaters analyst. Chad, it's good to see you. So lots of talk just about whether or not revenge travel is over, given the slowdown that we're seeing here domestically. What do you think?
Sure, thanks for having me. So yeah, I'd say leisure travel, kind of the typical revenge travel, was very strong in the past 12 to 18 months. Everyone who was kind of cooped up in their house was going on these once in a lifetime types of trips, and there was no price elasticity. What we're seeing right now is the group business, so association, corporate, weddings, those types of things, and the traditional roller bag business travel come back. So those segments have lagged a little bit during the past 18 to 24 months, but that's kind of where we're seeing the growth. And as you noted, in the third quarter, Hilton exceeded guidance and consensus expectations for rate and occupancy for the quarter. They exceeded on EBITDA. They raised Q4 guide compared to where consensus was. And they also gave a little bit of a look into 24 in terms of room rates and unit growth as well. And that was positive. Now, the stock has been working, and we are near 52-week highs. So this is a company that's beaten 10 straight quarters. I think that's why we're seeing the soft move today, but really good set of results that we saw.
When you think about the capacity that they're going to be bringing online as well, Chad, how do you expect that to also deliver to some of their longer term ambitions?
Yeah, I'd say Hilton plays a little bit more towards that mid end of the corporate and leisure travel space. People have been looking for them to move upscale slightly more for chain scales. Now, that usually benefits from the corporate flyers and stayers who want to use personal stays at some higher end properties. So it usually doesn't drive, as much kind of in the quarter, but some people are loyal because they want to stay at properties, in the right city, at the right location, or on the beach. But yeah, they've done a really nice job. They have over 170 million guests at this point in their system, and they're driving them more to mid-end properties in North America and abroad.
I love a good beachside stay, Chad. When we think about ultimately the competitive landscape here, we just saw what is potentially going to be a hostile takeover attempt between two other players within this industry. Do you expect more consolidation, or at least kicking of the tires of some of the deals within the accommodation space, as many of them are still reacting to and trying to get ahead of any type of furthering of a consumer that prefers staying at a rental that's listed on Vrbo or listed on Airbnb and not at one of these historical hotel chains?
Yeah, it's a great question. I think for Hilton and Marriott, kind of the major gorillas in the space, they've looked at some small acquisitions in the past couple of years, kind of bolt-on areas, kind of where they can't franchise or manage on their own. Some of the other companies have looked to grow more substantially. We're still seeing synergies that we would see historically. Marriott made an acquisition, I guess it's been 7 or 8 years ago, acquiring Sheraton, and that was a 10 billion plus acquisition. We haven't seen much acquisitions in the space, and I think the main reason is because the business model is phenomenal, right? You have infinite returns. Essentially, these business models are just leveraging their reservation systems, their connections, their loyalty, membership groups. And there's really little need to make major acquisitions. A company like Hilton spends over $2 billion buying back stock and issuing a dividend. And that's kind of where they want to deploy their capital. I think Marriott's in the same area. So these are companies that are going to grow 5 to 7% over the next several years. They have good signings, good pipeline, and I can't see them doing other acquisitions. But in terms of some of the smaller companies, I do think that is something that could help those companies move up in terms of memberships. And that's what you're noting here that we saw earlier this week.
Chad, it was a strong quarter here from the company, like you referred to here in your most recent note, also on here with us. But when you talk about the beat that we saw in the third quarter, the raise that we saw for the current year, looking ahead to 2024, I know you still have a hold rating on the stock. What's the catalyst, or what do you need to see in order to be more bullish on this name?
Yeah, we prefer Hyatt within the space right now. They lean a little bit more towards wellness, towards luxury. They still own some properties, so there's some catalyst that could come in terms of selling assets. Hilton, the main reason why we're neutral is really just kind of where their chain scale is. I think there's going to be some slight underperformance at that mid end just because of what we're seeing with the consumer. The mid to high end, corporate luxury, we'll be able to push prices, and we're kind of seeing that in the data, the forward data for 24. So that's probably the main reason. It's really just kind of a comparison versus some of the others. That said, Hilton's guide for this year and for 24 do bode well. It's a phenomenal business model. It's a great company that should always, in our view, trade above 20 times earnings just because of the franchisee aspect. So I think what we would need to see is probably an acceleration in leisure travel from where we are right now, and then that mid-end consumer having more purchasing power. I think those are the two major things right now. We have a $152 price target, so we'll reevaluate based on what we learned today.
Chad, always great to get some of your analysis and insights on the industry. Chad Beynon, who is the Macquarie Senior Gaming, Lodging, and Theaters Analyst. Thanks so much for taking the time.